Hello and welcome. The topic of today's discussion is, are big banks shafting retail Forex traders? My name is Darren Fisher. I'm the CEO of Maverick FX. Let's get started here. So, are big banks shafting retail Forex traders? This question comes up every few years, and it's starting to come up again, so we wanted to jump in and give our 2 cents on this. A little bit about us. Maverick Trading is a proprietary trading firm. We've got 20 plus years in the business, and our FX division, maverickfx.com, has been in business for over 10 years. Now, we trade at the professional, not the retail level, so we're coming at this a little bit differently. We are also not a bank, so we don't have any skin in that game either, and we're not a futures commission merchant or an introducing broker, so we're not making any money on commissions. Our sole concern is with trader profitability. So as far as it concerns our big banks shafting the retail Forex traders, we have no dog in this fight, which really means that this presentation is going to make everybody angry. That's okay. So, is collusion worth it? Well, let's follow the money here. Now, people are going to say and come out and say, they have done this before. They have colluded. They have tried to manipulate the market. And you know what? You're right. 2014, there was a front-running scandal in the Forex market. It involved 6 banks, and the investigation covered a period of 6 years. But there were $4.3 billion in fines because of this. Now, the only example of profits was a $99,000 profit on a 542 million euro trade. That is a market movement of roughly 2 pips. Let's take those 2 pips and set it aside, and still follow the money here. Do a little thought experiment. How much did they make? We're going to make some very large assumptions going forward here. 1, the big banks are going to be profitable in their shafting activities every single day and won't ever get it wrong. Now, I already know that this is false, but we're still going to make this assumption. If you go through and read some of the investigation, and yes, I had far too much time on my hands one day when I went through to read this. They did a lot of this through chat rooms and text messages. There are references to messages that said, man, you got hosed. Now, I don't know about you, but if someone says they got hosed, I have a feeling that the trade probably didn't go their way. So we're going to ignore that for a little bit and assume that they are going to be profitable every single day. And we're also going to say the average of a big bank's haul in their shafting activities is going to be $99,000 per day. So let's do a little bit of math here. Now, there's between 251 and 252 trading days a year. So let's give the banks the benefit of the doubt here and say 252 trading days. Now, $99,000 a day times 252 days, it's a profit of $24,948,000 per year. So let's round that up. So $25 million a year for 6 years. That's $150 million per bank per year. $150 million times 6 banks, $900 million total profits over 6 years. So what was the cost? There was the benefit. What's the cost? $4.3 billion in fines. It's 4.79 times their theoretical gross profits. Now, we obviously know that they didn't get it right every day, and I think what's far more likely, and this is just my opinion here, what's far more likely is that their profits were probably closer to half of that. And so that means that the fine was actually closer to 10 times what their profits were. Now let's take a look at some of the other things that had happened to them. Loss of reputation. I mean, this is something no business wants to go through. When this came out, these 6 big banks had a incredible loss in reputation. Loss of business. Now, these banks are primarily concerned with institutional orders, and we'll get into that in a little bit later. But when something like this happens, some of the larger accounts, they look at it and say, we really don't want to be associated with a firm like this that's doing this. So it's a momentary opportunity for the mid-tier banks to get some of this institutional business. And that can really hurt the big banks, both top line and bottom line. And you've also got employees going to jail. From an HR standpoint, this is a little bit of a nightmare. I mean, not only do you have the loss of reputation, the loss of business, but to actually hire someone on board, especially at this level, it's an incredible screening process. You're investing, time into, being able to screen these people, then bring them on board, background checks, then the time it takes to train them. That you've got to build them up to the point where they are in a position to actually, trade this type of money. And that doesn't happen on a immediate basis. These people are probably been at the banks for many years. Then they go to jail. You have to look at, okay, do we owe these people any indemnity? Was anyone in management involved? I mean, it really becomes a huge headache, from this standpoint. And from a business standpoint, that's a very poor reward risk ratio. So I'd probably say they're not doing it right now. This is probably the back in 2014, some people that got a little too big for their britches started colluding, saying hey, we can make this, we can make our bonus numbers this year. Really did not turn out well for any of them. So let's make a counterpoint argument right now that big banks did not learn their lesson in 2014. That they are still secretly colluding to systematically manipulate the Forex markets to the detriment solely of retail traders. That it is worth $25 million a year per bank for them to collude and front-run your orders. Does it really affect you, though? Let's take a look. Can big banks really move the Forex market? The Forex market of the latest report, the report comes out every 3 years from the Bank of International Settlements. The current daily volume of the Forex market is $5.1 trillion. So can these big banks really move the Forex market? Remember, back in 2014, there were 6 big banks. They were coordinated through a chat room and text messages. They were front-running their orders, and the orders they were front-running were the institutional orders. This all had to do with what's called the fix, where at 1 p.m. and 1:15 p.m. Eastern, the banks mark the exchange rate for any other settlements for that day. I think it's 1 o'clock for the pound and 1:15 for the euro. So they were focused on specific times of day when they were doing this. This isn't something they did, 24 hours a day. They had to focus their activities on 2 particular times, 1 p.m. and 1:15 p.m. Eastern. They only could do this in a single currency cross at a time. And they were only able to record, a $99,000 profit on a 542 million euro trade. That's the only thing that was actually given as an example, so we're just going to take that as the average. That is the equivalent of 2 pips. Now, let's talk a little bit about trading psychology here. You will get knocked out of positions and have them reverse immediately. And that's okay. You remember those trades because that's the way humans are wired. We don't remember the trades where the stop's triggered and the trade continued to go against us. That's just not what we remember. It's not how we're wired. Now, at one of the this is going to seem a little self-explanatory here, but one of the biggest indicators of whether or not you're in a trade that is good is whether or not that trade is going your way. That is the primary indicator. So if you put your stop out there at 20 pips and it immediately started going against you, chances are if it goes against you right from the get-go, it's going to continue to go against you, and you will get knocked out of the trade. So really, if you have to worry about a 2-pip loss, whether you're knocked in or knocked out, you need to take a look at the way you're trading as well. Here's the other thing. The assumption that everyone is making in all these chat rooms when they're searching for this, whether big banks are shafting retail traders, the assumption they're making is that collusion will cause a trade to go against you every single time. Now, that's statistically impossible. And remember, the banks don't always get it right. We've got records that saying they got hosed on trades, so they're not all seen. Now, nobody talks about the times when that 2-pip movement is in your favor. There are plenty of times out there that if the banks were colluding, you got an extra 2 pips in profit actually from the banks colluding. Nobody likes to take responsibility when things go badly. That is a mental defense mechanism to protect our egos. That's just the way we're wired. Everyone likes to think well of themselves. Everyone likes to think that they're smart. And you know what? If you're searching for this, you probably are smart. Intelligent people are the ones who trade the markets. But we also need to take a look at our psychology. That it's not always things that are people are colluding to go against you. might have to take a look at the way you're trading. Honestly, big banks could not care less about retail level orders. They are more worried about institutional orders and their own trades. Now, these institutional orders, a lot of times, the banks are using the FX market for exactly what it was designed for. They might have 500,000 euros and they want to get rid of those euros and actually get dollars. Or they might have 500,000 pounds and they want to get rid of the pounds and get their dollars back. They're actually just looking to exchange currencies. Now, if they are doing any trades on their own proprietary desks, if you talk to anyone that's been an execution trader for any of these large institutions, the amount of approval that is required to get into an actual long-term FX trade is multi-layered. So they are primarily concerned with their own trades and these institutional orders. They really don't care about the retail levels. So I hate to say it, but if you're having trouble trading Forex profitably, it's probably not the result of big banks colluding against you. You need to accept that your results are a direct reflection of how you're trading. So that begs the question, what does it take to trade profitably? Really, it takes three things to be successful in any trading instrument. I don't care if it's FX, I don't care if it's futures, I don't care if it's stocks, I don't care if it's options. Okay? You need three things. You need training, you need support, and you need capital. Now, it is deceptively easy for me to sit here and break it down and say, these are the just three things you need. In reality, it is a little bit more difficult. You have to take a look. We're going to take a look at each of these individually right now. First, training. Now, we are a proprietary trading firm here. And so the traders that come to us do trade our capital. Before they trade a dime of the firm's capital, they're going to go through 100+ hours of detailed instruction. Now, this is distilled from 100+ man-years of trading experience. Anyone who coaches at the firm, anyone who provides any classes at the firm, they've got some very extensive experience in the markets. And what we're doing, basically what it comes down to is we're distilling each man-year into 1 hour. What is the most important thing out of a year's trading experience that we can give to our traders? And this is structured. This is not random, and we definitely do not do this on the fly. For each hour class that we give to our traders, there's 4 hours of preparation, execution, and logistics involved. And this is not theoretical. Our lessons are hard-won with our own capital. When traders go through our training syllabus, we give enough theory for them to understand what's going on, and we spend the most of our time, actually not spend's not the right word I'm looking for, we invest most of our time in teaching people the mechanics and the ins and outs of trading. Support and coaching is next. Now, most retail traders try to learn on their own, but what are the results? Let's take a look at learning on your own versus learning with a teacher. Now, my son's in kindergarten right now, and he's 6 years old, and he's learning to read. He's learning to read far earlier than I ever thought to learn to read. But the reason that he's further along is because every day he has to read us one story, and we read him two. And so that's putting the practice in is good. Now, what's the difference between trying to learn your own or learning with a teacher? It makes sense if you're trying to learn to read that you learn from someone who already knows how to read. It's the same in any endeavor. There's always a little bit of a master-apprentice relationship. It's the same in trading. If you're going to learn to trade, learn from someone who already knows how to trade. Now, there is no college degree that you can graduate from a university and call yourself a stock trader. I mean, you can go get a finance degree, obviously, but that more gears you towards analysis. And then you could try to work your way onto a trading desk as well, but then it's very much a master-apprentice relationship with that too. So one of the main benefits of being in a structured environment is that you do have that structured syllabus. You're moving from step A to step B to step C down to step Z instead of going on your own on this random walk and going down rabbit holes. And I hate to tell you this, but just Googling whether or not big banks are systematically shafting retail traders, that's a rabbit hole. And this is time that could be better invested actually learning how to trade, learning risk management, learning a myriad of different things that would actually help you. Another thing you get is guidance. And along with that is coaching and mentoring as well. These three things put together are extremely important. That guidance tells you hey, you want to be looking at this, you don't want to be looking at that. The coaching, if you have any questions on the material, if you're on your own, you need to go and search for an explanation of the explanation. If you actually have some coaching available to you, you say, look, I got a question. Can you help me out with this? Can you explain what this means? Can you try to explain it a different way? Can you look at it from 180 degrees? We're happy to do that because it's in our best interest as a prop firm that our traders know our material inside and out. So if we have to set up a one-on-one session with our traders, we do it because honestly, from a business standpoint, it's much cheaper for us to invest the time early on in our traders than have them half understand something and 6 months later they get into a bind because they didn't understand that. And I can't speak enough about the mentoring. I'm CEO of the firm. We've got over 400 traders at the firm. We also have a staff, but I also trade on my own. And about every quarter, I take myself out of my current position and I go to one of our coaches. I know exactly the experience our coaches have ever had. I know exactly what they've been through. I've been here for almost, for 9 years right now. But I remove myself from my current seat and put myself back into the position of being the apprentice again. And we go over, my coach and I, we go over my trading plan. We go over my trade results. What worked, what didn't, what changes are we looking to make? Why are you looking to make the changes? What's going to be the effect on risk management? How do you expect that this is going to go moving forward? We go over everything. And that really distills down, why am I making a change? Do I need to make a change? Should I continue on the way I'm going? And that keeps you on track. It really definitely does help having someone that can have a dispassionate view of what you're going to do and ask you some pointed questions about why you're going to do something. Additionally, we offer active supervision. And that's extremely important for our traders to know. And we're going to get to this a little bit more in capital, but having someone be able to give you that dispassionate second set of eyes, that look at your trades, that look at your trading plan, that look about how you're going through and going over the material is extremely valuable because sometimes you don't know what you don't know. And capital. Actually, this is the least important factor in trading. And the reason is money finds results. Whether your trading success generates your own capital for you to trade more of, whether you run friends and family money, whether you go to a proprietary trading firm, whether you throw it all to the wind and try to open a hedge fund, money will find results. Most people concentrate on accumulating the capital to trade without considering how they're going to allocate it and how they're going to manage it. And that's one of the differences between a retail trader and a professional trader. Now, as a prop firm, Maverick FX has a vested interest in our traders. So we go over risk management with them from day one, and we go into it rather in depth. I mean, we're talking per position risk, we talk portfolio allocation, we talk trade management. Not only how to manage a trade if it goes against you, we talk about how to manage a trade if it goes your way. Do we want to take a look at legging into positions? Do we want to take a look at increasing the capital we're going to risk on a trade that's going your way? Adding more capital, moving your stop up, going to break even. We also take a look at trading multiple currencies. When people begin to trade multiple currencies, they think they're making individual separate trades, but they oftentimes don't look at it at a portfolio level. So we may have a trader with 5 or 6 trades on at any one time, but when one of our coaches looks at it and says, these 6 trades you have on, actually if you distill it down, you have eliminated 3 of your trades, and it might leave you with some currency crosses that are completely unintended because you didn't understand the relationship of how to trade multiple currencies, and we go into that in detail as well. Now, paying taxes on your profits as a trader is a high quality problem, but it is still a problem. So all of our traders invest an incredible amount of time and energy and resources into learning how to trade. Now, when they have a profit, we want to assist them in them being able to keep as much of that profit as possible. So we do have classes on trading as a corporation. We have classes on tax planning as well. We've partnered with a very reputable firm that is really the recognized experts in taxation as far as traders go. These are all resources that we offer to our traders so that they can make the most out of the capital that they have. So training, support, and capital are all vital prior to live trading. But your requirements for long-term success, they also goes back to those as well. You need continuing education. The markets change. Different techniques come out. Different events happen as well, especially in the FX market. You can have a very event-driven portfolio at times. And you want to know that that's coming up. You want to know what other people are, how other people are looking to trade that as well, so you can make some educated decisions. You also want to leverage that institutional knowledge base. This is where trading with a group of people that know what they're doing is very important. It's like science. You talk to any scientist and they say, we are standing on the shoulders of giants and learning from their prior mistakes, their prior successes, so we can go out and create new knowledge. It's the same in trading. Learn from other people's mistakes. When other people have risked capital and either gained or lost, learn from that so that you can go forward and make new decisions rather than trying to recreate the wheel. That dispassionate trade and portfolio evaluation. People sometimes will get so mentally invested in a trade that it begins to affect their emotions. And you need someone to take a look at it and say, look, you are underwater in this trade. And it is affecting your decision making as well. It is a drag on your portfolio. You are having, this one trade has knocked out the gains from 4 other trades. What you need to do is, liquidate the trade, book the loss, clear your mind, and learn and just move forward with a clear head. We have to ask some people, is this the trade that you want to have the catastrophic loss in? Is this the hill that you want to die on? And generally when we put it to people that way, they said, no, I do not want to take the catastrophic loss. This is not the hill I want to die on. Yes, I recognize that I became too emotionally involved in this trade. I need to just liquidate the trade and book the loss. And that rolls right into active supervision and risk management. Sometimes we can get, individually, we can get just too tied up in what's in front of us. We see one tree, we don't see the forest. The other thing, you want to be with people that are cooperative and collaborative. Trading is a team sport, and the sooner that people understand this, the better it is, the faster they become successful at this. You can try to go it on your own, but then you run into some of the issues that we have. You get emotionally involved in a trade. You don't have the benefit of anyone else's guidance. You begin to go down the rabbit holes in your training. You begin to take losing trades, and naturally you want to try to find a reason that's not you. So then you become, again, emotionally involved in trying to find something, when really what you need is just someone to give you a step back, show you what you're doing wrong, let you come to terms with it, give you, pick you up, dust you off, give you the support to move forward, and that way you can do everything with a clear head. So in conclusion, there is a 99% chance that big banks are not colluding to shaft the retail traders. On the 1% off chance that they are, their impact is fleeting and minimal. Okay, 2 pips. That's what their impact is. And sometimes their collusion, if any, will actually benefit you a percentage of the time. So it's not always going to be to your detriment. Successful trading requires professional training, professional support, and meaningful capital with the supervision that requires. So the quick plug for Maverick FX, that is our Forex division of Maverick Trading. We've been a proprietary trading firm for 20 plus years. Maverick FX has been around for 10 plus years. If you want to take a look at us, and you're looking for professional training, professional support and coaching, and access to meaningful capital and that supervision, I would say go to maverickfx.com, click apply now, and to learn more about us. We have a rather in-depth application process because we want to ensure that our traders know what is expected of them, what they're going to get in return, and that they are going to be part of that collaborative institution, that they're going to participate in our FX rooms, that they're going to be actively involved in their training, in their continuing education, they're going to actively monitor their accounts. So we want to make sure it's going to be a good fit for you as well. Anyway, thank you for your time, and wish you the best in your training. Cheers.